Martijn, welcome to our third podcast.
Thanks.
Third episode. The first episode was about technical debt. Second episode was about total portfolio management and everything around the institutional investors and portfolio management. Today we're going to talk about the retail investor. And not necessarily maybe the retail investor, because I think it relates to every person in the financial markets, maybe even every person, period. Today, we're going to talk about the mind. And it sounds a bit hush-hush, right? The mind, but the mind can be very strong. And the one who can control the mind can potentially control better long-term investments. And Martijn and I were discussing this topic, before we started with the podcast. We figured out that we both were really enthusiastic, passionate about this topic. So we quickly decided to make two parts of it. And so if you're super interested, skip in like the behavior, the mind during investing, skip to the second part. But I wouldn't advise. No, I would start with this one. Next to me is Martijn. Martijn, welcome to our humble studio.
Yeah, thanks guys. It's good to be here.
Would you mind introducing yourself to the audience?
Yeah, sure. You mind me to address the audience while I do it?
Address me. I would address the audience, right?
Yeah.
I know
when I talk to you, I will look at you, but otherwise the audience.
Sure.
So, my name is Martijn Rozemuller. As you can tell by my branded vest, with VanEck. I'm their European CEO, so I run the European business. I've been in investing for quite some time. I used to tell people that I started already before I actually got a real job. I was part of an investment society when I was in university. After finishing university, I went to become a trader on the options exchange, worked for a firm called Optiver.
That was 30 years already.
Yeah,
30 years ago, right?
Such a long time ago.
You started so incredibly young.
Yeah. I'm still quite young, of course. But Optiver. Optiver was a great way to learn about financial markets, financial products. After that, I started Think ETFs, Dutch ETF firm, which was acquired by VanEck in 2018, also already a long time ago. And that's in brief my career.
I think we know each other maybe for 10 plus years.
Probably,
already.
Yeah, at least 10.
Yeah, I would say so. Recently you started VanEck Direct as well.
Yep.
Quite successful already, and getting more and more successful every day. Relates a little bit to the topic today as well.
For sure, yeah.
Because I started a bit vague, right? Who can control the mind, can control long-term investment.
Like a Jedi mind trick.
Yeah, exactly. But it's a super important topic that I think relates to everybody, and that's why we both thought, we should really discuss this. And how can we split it up in two parts? And let's start maybe with VanEck Direct. And I don't want to make it one big marketing show for you. You don't need that. The platform doesn't need that. But VanEck Direct is like a direct investment proposition for retail clients. But it's mostly for retail clients that are starting to invest or looking for another platform to invest on. What are the biggest struggles for attracting new investors? What do you see in?
Well, it's basically best explained by a short story. You know me, I like stories.
That's why I invited you.
So a good friend of mine, he many years ago started a mortgage business. And they did very well, they grew fast. And he always liked to tease me with it, of course, because, their business grew quicker than my ETF business. And I told him that there was a good explanation for that, because his clients were very much aware that they needed him, because without him, they could not buy the house they wanted to live in. Mm-hmm. And that was something that you wanted right away. My business is basically making sure people have a good financial future, which is something that is, depending on your age, maybe 10, 20, or 30 years in the future. And this is something, and now we're already touching the subject a little bit, that people find really hard. it's really hard to imagine your future self and the financial needs that you have. So I used to tell them, well, your clients know that they need you immediately because otherwise they cannot do what they want to do.
Yeah.
My clients will probably only realize they needed me when in 20 or 30 years' time, their financial situation isn't as great as they hoped it would be. So yeah, that's the most difficult part, making people see that they need to start investing at a young age to have a better financial future.
And so this is behavior.
It is pure behavior. Yep.
And there are a lot of behavior biases. And I would actually say that behavior biases usually work against us.
Mostly, yes.
Right.
And if they don't, then some company will find a way to make it work against you. So you always should be very careful.
That might be something to discuss as well if we have some bonus time. But if we look at behavior biases, and we would split it up in people, not starting investing yet, because we know from theory that the younger you start investing, the better, right? Ideally, as soon as you can born, you open an account. KYC might be a bit difficult, but the earlier, better. But there, I still see in my surrounding, even the people I know quite well, to make it even a bit personal. Sister, I hope you're not listening or looking, but I was talking with my sister a few months ago, and she was saying like, yeah, Kees, I know that I should start investing. I know, but I'm not doing it yet. And I told her to make it at least a bit comfortable. I said, well, you're already investing a lot in your house and in your kids and in your, et cetera, et cetera. But yeah, she was right. She knew she had to start, but she didn't. What's in the behavior in the mind that's blocking her and maybe like hundreds of thousands of other people?
Well, there's a couple of things. First of all, there's something called status quo bias. People like things the way they are. People don't really like to go change things, or at least most people don't like to do that. And people are really good at something that's called procrastination. Basically to say, well, I can do this later. It's not something I need to do right now. I'll do it later. But if you keep saying that, it'll never happen. And this is at least one of the, I think, main reasons why people put off investing for the time being. They don't feel comfortable with it yet. They think, well, yes, I probably should do it, but I'll do it later. So that's the first issue.
Maybe shall we talk first right away how we can solve that? Because if you're listening in now, and I think procrastination, everybody recognizes that.
And it's not only with investing; it's also with the dishes and
especially with
your
the
administration stuff like that.
Yep. Until the taxes say you really have to do it right now. And then becomes even more relevant. But there's nobody that says you really have to start investing right now, right? Okay, what can I tell my sister, for example, if she's like procrastinating that part? Because she's obviously...
Well, the thing I always say is there's always a reason not to do it right now. There's always an excuse. There's always the idea that maybe it's also a better time if I just wait a bit more. And I think in the end, it's not about finding the perfect moment to start, because there is no perfect moment to start. But there is one really bad thing that you can do, and that is to never start at all. That's definitely the worst thing you can do. So if you hear those two statements, both of them are true, then I guess the only conclusion you can draw is, I got to start today.
Yeah, so procrastination, it's what I read is also that at least start indeed, but start then extremely small.
Yeah.
Right? If you want to write that book, at least start writing one sentence a day.
Yep.
And is that something you could do with investing, I guess, then as well?
For sure. Yeah, I think a lot of people maybe think that you have to be sort of all in or not, right? That it's more like a binary decision. And it's not. You can start in small steps. Actually, a lot of people don't have that big bucket of money anyway. So they're basically forced to start in small steps, setting aside a little bit every month and putting it in an investment. So yeah, for a lot of people, there isn't even the choice. But if you do already have saved quite a bit of money, I can understand that it's, well, a bit scary to put everything into an ETF or some other investment firm because well, you just don't know what will happen.
Exactly. Okay, so start small. But what I see then in practice, even signing up with VanEck Direct, you really have to go to a regulatory KYC.
Yep.
Yeah, street they call it, right? Like a whole, like
Yep. It's an onboarding process. It takes a bit of time. I think in our case, we've tried to make it as painless as possible.
yeah,
But there's also regulation that we need to keep in mind. And on the one hand, obviously, it's a little bit annoying because it makes it a little more painful for people. But on the other hand, I'm a big fan of regulation. I think it helps to at least get rid of some of the really dangerous products because if there was no regulation, a lot of people would make financial products that were benefiting themselves mostly.
Exactly, working against all those biases.
No, exactly. So they will take advantage of those biases, and I think regulation is a good thing. I also think you should manage people's expectations. So hopefully, if someone is now considering to make an investment, they will listen to this part. You'll have to invest maybe 10 or 20 minutes, maybe even 30 minutes, depending on how sort of capable you are working with your smartphone. But it'll take a bit of time. But there's good reason for it because we want to make sure that that the plan you get, because there is a plan involved. Investing is a long-term commitment. You have to have a plan, and we have to make sure that that plan really fits your needs. So any sort of other way to invest, for instance, opening an account at an online broker, for some people that works. Because if you really think, if you already sort of educated yourself about the market, about the products, then some people can just do it themselves. But there's many people that simply don't have the time or never really took the time to educate themselves, and they're looking for a sort of, more like a convenient solution. And I think with VanEck Direct, that's what we offer. It's quite convenient. But in order to make sure that we offer you the right service, we have to know a little bit about you.
Of course.
And we have to know about your risk tolerance, mainly. So it takes a bit of time, but it's, I think, for a good cause.
And then just start. Exactly.
And then just start. Just sort of, it feels almost like you can maybe compare it a little bit with, we all know that feeling probably when you're in the summer by the side of the pool and you do want to dive in, but maybe the water's still a little bit cold. At some point, you just have to jump.
Exactly.
If you go really slowly, it's.
Well, you do have to notice how deep it is, but once you did that, once you checked that,
you jump.
Exactly, just jump. And you mentioned education, but what I also see around me, education, is that when are people talking about the stock markets? Mainly, I find, and maybe I'm biased in that as well, but what I find is that people either talking about the stock market when it's already potentially at that point maybe a bit high, or you hear people a lot about bitcoins, or more recently about gold, right?
Yep.
But you sometimes, right, hear the stories as well about losses. Like, oh yeah, I lost 20%, 25%. They probably lost it because of a bias we're going to discuss in part 2. Cliffhanger.
Yep.
But if I hear that story, and I'm keep procrastinating my signing up for I had to start investing, I might be a bit scared as well, right? Like, see, he or she they lost 20% or 25% of their portfolio. Is there some? Do you recognize this? Do you get questions like this as well from clients?
Yeah, of course. Because I think, the media pays attention to, let's say, stock exchanges when either things go really well or when they go really bad.
Yeah.
So it really sort of magnifies what happens. Because if nothing happens, you'll hear nothing. And most of the time, nothing happens. It's
Yeah.
only at certain points in time where a lot of stuff happens. So
But you don't hear on the news like, oh, it recovered again 20% up.
no, and
Or that's
also
not.
you don't hear, oh, this week was very boring. Because if the week was very boring, then they
Yeah.
will not write about it, right? So that's the first thing. Then what you also should keep in mind is, and this is something Warren Buffett once said. He's like a very old and wise investor. I think, I think he's a great example, or he could be a great example to many people. And one of the things he said is on his own investment strategy is sort of he gets a bit fearful when everyone gets greedy. So
Yeah,
when the
exactly.
newspapers are writing about, oh, the stock market is going up very well, gold is at an all-time high, a lot of people are greedy. They get,
Yeah.
well, one of those biases, fear of missing out.
Exactly, the FOMO, right?
Try to
Yeah.
be part of that. And that's usually not the best timing. And then Warren Buffett says, well, and the opposite is also true. When everybody's fearful, I get a little greedy because that is usually, especially in hindsight, a good moment to start.
Yeah.
And I would like to add to that, if you're already invested and if you already have a sort of a monthly subscription plan, you put money in the stock market every month, you should probably try to not look at the market at all. You should probably just try to ignore it. Because the only thing that can happen if you do look at it is that either you become a little bit too greedy or a little bit too fearful.
Yeah.
And in both cases, it usually doesn't end well. So you have to be kind of agnostic, and you have to try to eliminate your emotions as far as you can.
Yeah, completely eliminate. But then
That would be great, but that's hard.
but that's hard. And
But at least then it helps if you're not looking at it, because your emotions
Exactly.
will only start to come into play if you look at the market.
Yeah.
And then you have to sort of, you have to have an opinion, right? And if you have an account with a bank or broker, they will very likely, and I'm talking about execution only accounts now, they will very likely have a website or something on some app
Trade
that
now.
gives you a lot of signals.
Yeah.
And these signals are meant to, well, incentivize you to do something.
Yeah.
And it feels good to feel like you're in control, but you're probably not.
Exactly. But that's a bit of a cliffhanger again for part two, right? When we're getting back to like so many people that are still not starting yet, I'm looking as well at what are other factors or biases that people don't start yet, and what I was thinking as well, like you could also say, okay, I have this €1,000 left now, or X amount of money left now every month. Hey, but I could also buy that premium subscription of XYZ, or buy this now for instant gratification, right? How can we make sure a long-term investing gives them some form of instant gratification? Because it's
What helps a little bit, I think, is to visualize what can happen over time. So both on the VanEck Direct app, but also on our VanEck website, we have the ETF Academy section. You'll find some examples and actually some things you can toy with, where you can say, well, listen, so my investment horizon is maybe 20 or 30 years.
Yeah.
I want to put aside maybe 100 or 500 or €1,000 a month. You pick a certain risk profile, and there's like a default average yield involved.
Yeah.
And it will show you how your investments will grow over time.
But doesn't that always look a little bit too fancy in my or in a view, or not?
There's two ways to look at that. I think it looks a little bit too smooth from the perspective that, yes, if we have to calculate on an average, then the line will look very smooth.
Yeah.
And the smoothness of the line, that is definitely not going to happen.
Yeah.
Because
That's one thing we know for
it
sure.
will be erratic.
Unless you just put it again on a savings account or a cash fund or something like that.
But the end result in 10, 20, or 30 years will probably be quite near or quite close to the actual outcome. Because the thing with the stock market is, it is really hard to predict it for the next couple of days or even the next couple of months.
Yeah.
But to predict what will happen in the next 10, 20, or 30 years is a little easier. And mind you, not able to guarantee anything, but over longer periods of time, research has shown that it becomes a little bit more predictable. It's actually completely the opposite of the weather. We're sitting here, I'm looking outside, it's raining, and I could have known that because weather predictions are usually quite good
Exactly.
for the next 2, 3, 4, 5, 6 days. But if we were to forecast the weather for the next 20 years, yeah.
Yeah, we know it's getting warmer, but that's about
That's
it.
probably not. So the stock market is the opposite. Short-term predictions are usually BS,
Yeah.
but longer-term predictions can be pretty accurate. But yeah, you have to keep in mind that on the way there, the market can move quite a bit, which is exactly why you need this long-term horizon.
And basically not look at the news or ignore,
Yes,
try to
things.
ignore the
It's hard. Try to do it.
stock market. Yeah, I visited a family office a few weeks ago, and I heard a great story of them. There was like from a client that said, okay, they have only two conversations a year with that client because the client is a little bit older and she didn't want to be bothered about everything. And they had the discussion early in the year and at the end of the year, and it was exactly in Corona. And at the end of the year, they had the report to discuss it, and she was like, "Oh, yeah, I actually made quite an okay return on my portfolio. Yeah, it's a bit. Why didn't you guys make more return?" Well, client, I have to tell you, was minus 20% at a certain point. But yeah, it recovered quickly. But these are quite anecdotal. But it's in line with what you said. Yeah. Ideally, you ignore it.
Yeah.
Right? You just put it on.
It's unfortunate but true that a lot of people during that year sold their positions when it went down because they were too afraid it would go down even further. And then, yeah, if they had done that, and yeah, unfortunately, many people did, and then at the end of the year sort of looked again, man, they will have regretted that decision.
And when you're interested in this part, look at part or listen to part 2, because we're going to talk about how we're going to make sure to overcome this bias, right? If we so let for the people listening that say, okay, Martijn, Kees, thank you, you convinced me. I keep procrastinating. I recognize this bias. I recognize this behavior. However, I do still have this lump sum of money because for whatever reason, or I just always saved.
If you procrastinate long enough, the money will keep growing.
If you save once in a while, then exactly. But if I look at from a study point of view, like a scientifically point of view, timing the market is undoable. You mentioned it yourself with the weather.
It is.
And if you look at it from a scientific perspective, you have to invest it, boom, lump sum. There's so many research shown that, okay, if you're gonna do a little bit over time, eventually the lump sum right away is in average the best, right? And you obviously you can't exactly confirm that or advise that, but or you could.
Well, the thing is, for a large group of people, it's best if they all just do a lump sum. But for each individual person in that group, there's definitely moments that would have been better or worse. But yes, for the group as a whole, doing it at once is best. Which I guess still can mean that if you are an individual in that group, and you don't feel entirely comfortable with the lump sum approach.
Because you procrastinated already for years, right? So
then why not do a monthly dollar cost averaging for a limited period? Don't stretch the period too long, but say, okay, listen, I'll divide my money into 3, 4, 5 equal tranches, and I'll do it this month or next month, and yeah, but you make it a little bit maybe easier on yourself that way. It's definitely not guaranteeing a better outcome, but maybe it feels a little bit better. And if that helps someone from procrastinating, then it's probably a good thing.
And it could happen, right? That if you deposit or start investing with the big lump sum next month, it is minus 10%.
Yeah.
It could definitely happen. But we'll talk about that later on as well. What other biases do you think are influencing our mind that we still procrastinate or that we don't do it?
Well, they're not per se biases, although I think you studied the subject a little bit more recently than I did, so maybe you can teach me a thing or two. But I think there's at least a couple of reasons other than the ones that we mentioned. So first of all, still a lot of people believe that you need to be quite wealthy to start investing. It's not true anymore. You can start with small amounts.
Well, it used to be like
It
45,
used to be
50
that
years
way, but
ago.
it's no
And
longer that way. Also, people think you have to at least have a certain amount of knowledge in order to make the right decisions. Get it? Also, not necessary, and it sounds strange. Obviously, you need to have a little bit of knowledge, but it's mainly the type of knowledge where you are able to at least verify whether the company that you buy investment products with is at least like uh, regulated.
Exactly.
You could also look up maybe a few online reviews. It's good to at least look up sanity checks. But you do not need to know how stock markets work exactly. You don't need to know which companies to buy exactly. So there is less need for education than people may think. Um, and then, yeah, the timing, we discussed it earlier. It's also not necessary to be able to find the right moment because there is no right.
Exactly. That's the
There's
timing again, right?
exactly there's only the wrong moment, and the
Yeah,
wrong moment is
it's
never.
not. Exactly.
Uh,
No.
Other than that, everything is much better than people think.
And there's besides VanEck Direct, there's other platforms as well, right? And
You know, many actually.
yeah,
Direct is, as you know, the smaller part of our business. The bigger part of our business.
still, right? I mean,
Yeah, still, who knows? Maybe in 5 or 10 years. But at this point, by far the smaller part. But the majority of our business is basically issuing ETFs that people can buy through banks or brokers. Even sometimes your pension fund may use them, or your insurance company.
but I also hear around then especially the bit younger generation, and when I'm talking about investing and they're like, yeah, it sounds like I have very boring birthday parties that I'm talking about investing the whole time. It's not true, right? Most of the time, but what I hear also like, oh yeah, I start investing because I started with this XYZ brokerage account a few years ago, like an option 24 or something like that, and then I start thinking like, oh my god, why is this person thinking he or she is actually investing? What kind of tips can you give me or the one listening that is not procrastinating anymore now after this podcast? Knows, okay, ideally you have to just do the lump sum thing, but hey, maybe dollar cost average, so every month or a year or something like that, adding something. Obviously, we know one a great platform, but what are the things that we should look for? Like, what are the warning signals maybe that you're like, because there is.
Well, first of all, you can check with the local regulator. AFM has a database. It's public.
Yeah.
So you can check if you're uncertain about a certain company that you want to do business with. You can check if they are listed in the AFM register. That's the first check I would probably do. And if you want to keep it more simple, as long as you have an investment account with one of our big well-known banks in the Netherlands or with one of the big well-known online brokerage firms in the Netherlands, and I should probably name names because that will help. And if I name enough, then I'm not, well,
Sure, go ahead, yeah.
Or recommendations. But so for the banks, if you have an account at ABN AMRO, ING, Rabobank, or Van Lanschot Kempen, you're fine, right? They are all regulated. If and anything you can buy through those investment accounts, they have already scrutinized. They have checked it as well. And if those products were not regulated, then they wouldn't sell them.
Exactly.
So that's already quite safe. Same goes for Saxo Bank, De Giro, Links. There's many online brokers that have this same regulation as a bank that offers security services. So they too have to have all these checks and balances in place. The last thing, if you buy a product through their account, it's probably a listed product on Euronext, Amsterdam. To be listed on Euronext, a product has to have approval from AFM, from the local regulator. So as long as you are in this regulated bubble, well, I'm not saying nothing worse, nothing bad can happen, because even those investment products, they can go up and down, but they are regulated. As soon as you step out of that, and there is definitely some, well, online opportunities, let's call it that way,
Yeah.
by companies that mean less well, that are not regulated, and that sometimes you have to basically wire the money to a person, and that person will do it
That's
for
even,
you.
yeah, yeah.
And we read about that, unfortunately, all the time, and
Yes,
people still do it. And that is obviously a big red flag. So, yeah, my advice would basically be stick to the well-known companies that are regulated, that you can actually verify that they are regulated. And then at least you will not run the risk of someone basically taking your money and running away with it.
Yeah, thanks. And maybe to go one step further, even the regulated platforms with the regulated products, the ones you mentioned, if the horizon of investing is the longer term, right? I mean, the longer term, the longer the better, basically, right? The shorter term, well, think about your weather story. The shorter term, the worse in terms of the stock market to predict something. Would a red flag then as well be that, hey, if they incentivize trading a lot, that's probably maybe, well, I wouldn't say a red signal, but it's not a great sign.
No, it's usually not a great sign. And also, and this also happens a lot these days, that people will start a fake WhatsApp group or some other online initiative.
Yeah, you see that?
We see it as well, and people are actually, well, stealing basically someone's identity. I've not come across myself, fortunately, but I've definitely seen colleagues of mine that were, yeah, basically their identity was stolen. Someone would say, hey, listen, I'm this and this, and this is great advice, and please transfer the money. And luckily, more and more people these days are at least aware that you need to be careful in those situations. And we actually get emails from people saying, hey, is this actually a VanEck WhatsApp group? And we always tell them, no, we don't have any.
Yeah, oh, it happens, right?
But it does happen. So yeah, you have to be very careful these days. But again, if you have your investment account with your own bank, with a well-known broker, and you buy your investment products, hopefully ETFs, through Euronext, then you're all in the regulated system, which at least makes sure that the money is not, well, stolen by someone. Still, investment products can go up and down. That keeps happening, but if you have the long-term perspective, you should be okay.
Yeah. So stop procrastinating if you have some lump sum there. Theory says do it right away, but that's the theory. Find a regulated platform that's not incentivizing trading too much, because hey, you want to be for the long term. Okay. Things. Are there any other things that, or maybe even from personal experience? Well, yeah, if we go to personal experience, I mean, it's been a while ago for you, I guess, when you started trading, and a while ago because you started very young age. Do you still remember one of your first trades, Martijn?
Oh, for sure. Yeah, so I guess I probably remember actually my absolute first trade.
Really?
And it was a warrant. You don't see those a lot anymore, but a warrant is kind of comparable to a call option.
Yeah.
And a call option is basically a right to buy something in the future at a price that is set today.
Yeah.
So my warrant was actually the right to purchase ING shares at maybe in 1 or 2 years' time. And I think it was probably 1991 or 1992 that I made that first investment.
And was low volatility, not so much risk in the market?
It was actually higher volatility, because it was it was.
So the markets went up and down quite fast.
Yeah. And
Lots
a
of
warrant
premium.
is a little more volatile than a share.
Exactly.
But I do remember the purchasing price. It was 2 guilders 35. And I think I kind of doubled the money on that one. So immediately I thought, I'm great at this. But that was my first investment.
And then you thought I hear this more, right? My first investment, the one that was great. probably maybe your second one, you probably invested. I shouldn't say the word invested, but you put more money into a warrant.
Actually,
We
that
didn't
was
rehearse this, right?
no.
But this is
The
usually what you hear, right?
Yeah, the second one probably was a call option. OC van de Grinten, Dutch firm, and they made copy machines.
Yeah.
I think they were located somewhere in the southern part of the Netherlands, Venlo probably. Anyway, that also went well.
So your second trade, which was more speculative, obviously, but the second
Yeah, it
trade
was a little
was.
more speculative than the first one. But I've definitely had a bit of luck. Let's put it that way.
Which is a bias.
It's definitely a bias. I'm not able to explain it exactly, but you do see why beginner's luck is a term. It does seem to happen. So yeah, I guess my first couple of trades were good. I was part of the investment society. We're couple of students always sort of debating and discussing markets and basically making our decisions based upon the outcome of those debates.
Nice, yeah.
But there were definitely also some bad outcomes. I think after 4 or 5 years when I left university, I think the portfolio that we managed, there was also we had a committee and it managed a certain amount. It was not basically my money, of course, but it was like the society's money. I don't think it really grew that much over the 4 or 5 years. So that probably means that we definitely had some bad investment decisions too.
Yeah, and you didn't know what you know now, of course. Like
I
just
definitely didn't
some
have the
widespread
knowledge I have now.
ETFs. Yeah.
I also know for a fact that even if I did have had that knowledge, I would probably not have used it because when you're in university and you want to learn about markets, doing a buy and hold investment
That's
for 10 or 20
boring,
years
right?
is quite boring and
Yeah.
you'll learn maybe less.
Yeah.
Which is also why I think it's good to be maybe a little bit more adventurous when you're young and the amounts you invest are smaller, because it will teach you that, yes, there is a downside to being adventurous when it comes to investing. And it's better to learn that with small amounts than with bigger amounts.
Thanks, Martijn. I think we can even talk for much longer about the biases, but I think the most important biases, you mentioned them, that the behavior that we're doing or not doing to make sure that we're not starting or are making sure to start investing. So thank you for that, for mentioning that. What I would really like to talk with you as well about is, okay, once you start investing, so take a little leap of time, 30 minutes you mentioned, right? 30 minutes, so I'm starting investing. I would really love to have your input on the second part of the podcast, when we invested, because I think a lot of people, and including myself, can learn from that as well, because big mistakes happen there. Thank you so far for part one, and hopefully everybody can join me to part two.